Nick, it's good to see you. Today we are talking about 3 ways to maximize your retirement income and minimize your taxes. We've said this before, if you don't have a tax plan, you don't have a retirement plan.
And it's synonymous with another phrase, which is retirement planning is income planning.
Yeah.
And taxes wrap all into that. It's not what you make that matters, it's what you get to keep that matters. And that's been cliche. I mean, I've been saying that for 20 plus years. So income planning, if you make $5,000, but you only get to keep $3,000 of it, that's not a good plan, which is why taxes are uber important. If you can make 5,000 and keep 4,000 of it, that's going to help you. In essence, you've raised your income just by being tax smart.
Right. It has to go hand in hand.
It does.
So let's break down a few strategies for anybody who is nearing retirement age. And first on your list of considerations, Roth conversions. Why is that?
Well, you got to create tax-free wealth while it's cheap. And what I mean by that is right now, taxes are at what I would call a discount compared to where we've been in the past. If we go back to World War II, the highest marginal tax rate was 94%.
Ouch.
Yeah. Think about that. The government was making more than you were by a lot. Okay. So if you think about that, look at where we're at right now, where we're at the, upper over 35%. It doesn't really look so bad. And what's sad about it too is the government knows this chart. And this is why when they look at this, they look at it a little differently. They look at this like, oh, there's a lot of room for taxes to go higher because we've done it before.
Right.
There's a precedent to raise taxes, so we may as well because it's happened. So you got to be tax efficient. That's why I say now do it because it's cheap, because tax rates are low compared to where they've been in the past. And you got to be smart because your most tax inefficient money, if you think in retirement, are these IRAs, these 401ks. If you got $1 million built up in these IRAs and 401ks, the moment that you take money out, you're taxed on it as if you earned it, which makes it tax inefficient. So what you got to do is take that money and make that money tax-free. In essence, cleanse it of its taxes now while taxes are low so that later on that money doesn't have any taxes on it. Now, the bad news is you got to pay the taxes now to get that money from an IRA to, say, a Roth through what they call conversion. And you take it from here and you put it here and you cleanse it of its taxes. Yep, stinks, got to pay for it. But then whatever this grows to over in the Roth is growing completely tax-free.
Right.
No required minimum distributions, passes on to your beneficiaries completely tax-free. When you take distributions from that Roth, it's also completely tax-free, doesn't affect Social Security or things like that, taxation on Social Security. So just look at where taxes will be. If you sit there and you think, I think taxes are going to be higher in the future, then now is an opportune time to take advantage of things before tax rates actually are already set to go higher January 1 of 2026.
Right. I think most people do believe taxes will go higher.
Absolutely.
So you mentioned, Roths do not have those required minimum distributions. I'm glad you brought that up because our next strategy here is to simply have an RMD strategy. A lot of us think, all right, I'm going to turn a certain age. I'm going to start tapping those accounts, taking those distributions, but that can leave you with quite the tax burden.
Oh, it does. And so what you can do is actually the older you get, I did a study. I'm kind of a numbers guy at times. Of course I did. You kind of knew I was going to walk in with a spreadsheet, right? In this particular spreadsheet, you can see it keeps going. But here's the bottom line. All these numbers, only 3 really matter. This is a person who's 73 years old. They have $1 million in an IRA account. They're in a 20% bracket for taxes. And I only assume their money is going to grow by 4%. Now, this is a person who told me I don't have a tax problem because they were like 73. They didn't really have the issue. I said, no, you actually do have a tax issue. And they said, well, why? I said, well, you don't need this money for anything, right? They're like, no, we just want to leave it and pass it on to our kids. I said, well, when you hit 73, your required minimum distribution is going to be close on that $1 million is going to be close to $40,000.
Holy moly.
When you're 73. She's like, yeah, but as time goes on, it will go down. I said, well, no, by the time you're 80, it's going to be $50,000 that you have to take as a minimum distribution. So you went from 40 to 50. Now at age 90, it goes to 65,000. So she's starting out at 40. then 50, then 65,000 over years. So as
Right.
time goes on, you're actually having to take out more and more and more and more. So what happens when you take out those minimum distributions is it can cause your Social Security to be more taxed. And
Hmm.
this is why, I've alluded to it before. I'll beat this dead horse again. That IRAs, 401ks, 403bs, TSP plans, 457s are all pre-tax accounts that are basically ticking tax time bombs waiting to go off.
Right.
And so a couple strategies here. Maybe look at spending down your IRAs sooner. What some people will do is they'll retire at 65 and then they start spending all their Roth money first because it's tax free. And it's like, well, I can just take it out of here and I won't have any taxes. Yes, that's true. But then what ends up happening is your tax free wealth hasn't grown as quick. You're spending it down. And then all that you have left later on in life is the most tax inefficient money.
Right.
So get that money out of that situation. Another thing too is maybe try and convert money, and I already alluded to this earlier, but get money from IRA to Roth so that you can have your required minimum distributions are less.
Hmm.
Okay, if that lady had $1 million all in IRA and she's taken out $50,000, if she had half of that money in an IRA and half in a Roth, then she wouldn't have required minimum distributions, and her required minimum distributions would in essence be half. And
Right.
another option too is what they call a qualified charitable distribution, or a QCD. And we have a lot of clients that they give money to their church or their charity. And what ends up
Right.
happening is when that happens, they cut a check. They go into their purse, they cut a check, and they put the check in the basket, and that's what they do. But if you have an IRA, and let's say you had to take out $10,000 for your required minimum distribution, that's normally taxed. But if you use a QCD, you can actually take that money, have the IRA give that RMD to your charity, and now it's a deduction. So if it's a $10,000 tax here, it's a $10,000 deduction over here for going to the church. You're just paying them out of this account as opposed to your bank account, or as opposed to your checkbook, and then it's a wash. And so this is a strategy that's taken a lot to get used to because people didn't understand them, but now it's starting to become much more commonplace.
Right. And such a win-win for everybody, not only
Yes.
helping you, but helping your charity as well. I like that one. Last, of course, healthcare is almost always your
Oh
biggest
yeah.
expense in retirement, which is why you encourage everybody to look at opening a health savings account. They are uniquely triple tax advantaged, Nick.
Oh, I love them. And Fidelity says that the average couple over the age of 65 in their lifetime is going to be at 65 and older. A couple is going to spend over $315,000 in just medical related expenses.
Wow.
So you better have some money saved up in a bucket or a lockbox for that. And there's no better way than an HSA, a health savings account, just because you can get, when you put that money in, you get tax deductions into that HSA. It grows tax free. And then when you take that money out, it's completely tax free then. So you get these great tax benefits, taking money out tax free, putting it in, getting a deduction. It grows tax free. But some people will misconstrue and think, oh, I don't want an HSA because I got to spend that money every year by the end of the year or else it's gone. That's not true. That's called an FSA, flexible savings account. So a flexible savings account, you do got to spend it by the end of every year. But an HSA, I have a gentleman who just came in last week. He has $60,000 built up in his
Good for
HSA.
him.
It's amazing. He's done it
Yeah.
for years. He's like, I've been healthy, but I'm not going to be that way forever. I'm taking care of my mom who's very sick. He's like, so I don't know when I'm going to touch this money, this $60,000 that he's built up in this HSA. But he's like, I know it's going to keep growing tax free when I take it out tax free, and I got a deduction to put it in. It's a win-win, and it's a great thing. So definitely, if
Mhm.
your company has an HSA, definitely look into the options. Just talk to your HR company and HR department and say, hey, do we have an HSA? And start putting money into it.
Yeah, such an incredible strategy.
It is.
All right, Nick, if somebody has questions about any of the strategies that we've covered today or trying to determine if a Roth conversion is right for them, what's the best way to reach you?
And when it comes to taxes, that's one of those things you just don't want to guess. And so
Right.
just give us a call. 844 Group 10 is the easiest way to really set up just a 15-minute check-in to see where you're at, and get some guidance on this, because the clock is literally ticking between now and 2026 when taxes are going up. So now's an opportune time to take advantage of these rates while they're low. And I know we don't feel that way, but it's the truth. And take advantage of these opportunities while they're able to be had.
Right. All right. Nick, thank you so much.
Aaron, great being with you.